Good morning, folks, and here's welcoming you to another edition of the Weekly Wrap. I hope it's useful to you. The week we have seen major news from S&P, who have upgraded India. So let's talk about that. We'll speak about how global fund managers are viewing India, how global fund managers are viewing the entire world as far as equity markets are concerned, what bond markets are doing in India, and of course, what's happening to US policy. We cannot end any session without that. So what's been happening? We've seen global equity markets having an outflow of $41.7 billion, out of which almost $27 billion is accounted for by US stocks alone. So we've seen a large outflow from the US markets and in general over global markets. We've also seen a large outflow from Indian markets. India specific ETFs have been seeing redemptions, and we are seeing, or rather a Bank of America fund manager survey says that India has moved from a very much overweight position to a very much underweight position given what's happening here. So globally, managers are worried that we'll see a slowdown, and US in specific, the job numbers that have come out, the corrected job numbers that have come out show a weakness. So that is going on at the back of everybody's mind. The impact of tariffs in general are going on, and inflation. So all this confusion has led to a significant outflow in stocks from the US and also India for slightly different reasons. As far as India is concerned, managers are not worried about the macro. Managers are more worried about what's happening to earnings. As we have discussed in the past, earnings have not seen significant growth. They're very, very tepid. And managers across, whether they're Indian managers or FIIs, seem to be thinking that it would take a couple of quarters for earnings to recover in India. Until then, we may see a very lukewarm market, whether in terms of flows or growth. We would like to see some direction coming in before making fresh commitments. But in any case, it does seem that large caps are still the flavor of the season. Almost all the flexi cap funds in India are more tilted towards large cap than the mid and small, though they have a freedom to go anywhere, as you know. And that is because you will also see that the profit pools contributed by the large cap, and as compared to the valuations and market cap, are significantly going up. There was a period when the relative movement was down, and now we're seeing an uptick again. And it does indicate to us investors that given the higher profit pools relative to the valuation of large caps, it is the better place to be in. So that is one thing. Then we have seen the major news as Standard & Poor S&P raises India's rating after 18 years to BBB and a positive outlook. Is it something that we have to be happy about? Well, yes, it does. But we seem to be getting into a phase where we are really not worried about validation by Western agencies. Okay, and of course, the S&P says that this upgrade is largely because of improved macro numbers, a sustained focus of the government of India to reduce deficits, and also its ability to focus its spending on more productive areas like infrastructure rather than subsidies. So if you do remember, many years ago, the government would spend more on subsidies than on capex. And that has, over time, given the strong political will, this is reducing, and it's doing good for the country. Okay? But really the concern is that as per S&P, our per capita GDP remains very low. Yes, we may be the fourth largest economy on the world, on the way to becoming the third largest economy. But if you get it down to unit economics, as people would like to say, the GDP per person, given our large population, the per capita GDP immediately falls to a very small number. And that is where we need to be improving. Let us not get complacent in the fact that we're the fourth largest economy. As far as per capita GDP is concerned, we are still very, very low. And that work needs to be done in general. But a little bit of history here. It seems that S&P has taken 18 years to to give us an upgrade. Okay. Now we are at triple B. We were at triple B minus earlier. We have moved up to triple B. And do you know when it was that we had a triple B rating last? It was 91, 92. That is when we had a triple B rating. So it's quite funny that we had a better rating when we were probably at our weakest. You all do remember that 1992, we were pushed into a corner, and that is when liberalization happened. And in those days, we had an inflation upwards of 11%, closer to 12%. Our fiscal deficits were 8.5% or so. Okay. And from there, today, we have half the inflation number, half the deficit number, sustainably, not a flash in the pan performance. We've grown significantly stronger, not this year. We've been getting stronger in the last few years. But Western rating agencies are so politicized that they never bother to give us an upgrade, in spite of many petitions. Anyway, we have it now, so let's see what happens. Bond markets were happy after the S&P rating upgrade, because with a better country investment grading, we can expect more inflows into the country, into the government bonds. So you will find more foreign institutional investors buying Indian government bonds, which is why bond markets were happy. Otherwise, post the monetary policy that had happened a few days ago, bond price had fallen, and where our 10-year bond was at 6.36%, 6.35%, it had gone up to almost 6.5% over disappointment on monetary policy. And on Friday, after the S&P rating news, it has improved a bit. And I do think that the next week we'll see even more improvement, because the inflation numbers that came on Friday were very good. Good in a way that inflation has come down to such a low. Okay, this is, as the paper says, an 8-year low. Okay, retail inflation fell to 1.55% in July, the lowest in 8 years, from 2.1% in the previous month. Even wholesale price inflation has fallen to very low levels, largely driven by both food and mineral oil, that is crude oil as opposed to edible oil. But the one thing that we should keep in mind is that while we could be happy that inflation rates are falling, why is it falling? So you know that inflation has two sides to it, supply and demand. Okay, if demand is low, prices won't go up. So this very low inflation is also reflective of the low demand situation in the country. We want demand to be higher, and we are all waiting for consumption to go up. So let's not forget that part of the inflation equation. Okay, and we are hoping bonds will do better, because if you have bond funds in your portfolio, you will see that their NAVs would do better with better bond prices. Okay, so before we end the session, let's take a look at what's happened to US global policy, the tariff policy. There's no real improvement over the week, except for the fact that the US President Trump has had a meeting with the Russian President Premier Putin, and they seem to have had some reasonably positive talks. If they are able to come to a reasonable understanding, we can hope that the additional sanctions on India, because we buy Russian oil, will also be taken off. So let's pray for that. But there's an article here by Rajrishi Singhal. It says, "Look east to understand why Trump is ghosting India." Okay, so apart from all the traditional consensus views, he says that we need to look back at how US was treating India earlier during President Nixon's days, when again quite a similar character, similar to the current US President Trump, and he and Kissinger had a very bad view to India. Even through the war in 1971 with Pakistan, US was supporting Pakistan and was ready to send its 7th Fleet into the Bay of Bengal to support Pakistan. If it wasn't for the Russian support that we received at the last minute, the war at that time would probably have taken a different turn. But since then, the reason why the US has been possibly supporting Pakistan versus India, whether it was in 71 or whether it is now, they are using Pakistan as a conduit to reach China to cut deals. Now, even in this tariff war, China has not blinked its eyes. In fact, it has imposed reciprocal tariffs. It's holding tight. It is cutting off rare earth exports to the US, which are so crucial to it. Okay, so because of this, US needs to be able to have a quiet backdoor negotiation with China, because losing in the game, and Pakistan is possibly the route for it. Just like it was in 1971 too, US wanted to have access to Chinese markets, but China was resisting. It was close to America. It was closed to America. And at that time too, Yahya Khan was used as a conduit to reach China. It worked then, and it's possibly the same rule that they're using today also. Otherwise, we need to be continuously wary of what tariffs could do. It does look like things are improving, and markets may be more positive the coming week because of this development, but we never know what happens. So never bet on anything in the short term. Take longer term, medium term views, especially when it comes to equity. Okay. Have a good weekend, folks.